time for Under 30. Talking Match, talking Bumble, looking at the dating app world. Joining us now, resident expert, no, I'm just playing, George Tillis, senior markets correspondent for the Schwab Network. George, I'm just playing. We were talking about this before. Look, I don't remember the exact stats. I'm sure I could pull it up, but more people meet this way on these apps than any other way nowadays. And it's been this way for a few years. I mean, this has been a huge technological shift over the last decade.
Yeah, I mean, I'm far removed from these apps by all means, but these are the secular trends. Obviously, people are now meeting digital online through digital apps like, Bumble and also Match.com and all other underlying brands like Tinder, for instance. And these are secular trends that are just continuing to grow. But if you look at some of the performance of these names, in particular, both of them, Bumble is down, I think, about 50 or so percent over the last year, and Match down 30%. I think there's some challenges on a per company basis, but perhaps also some challenges from the macro environment from the standpoint of the way these companies actually generate their revenues. The majority of the revenues for these businesses are user-based fees, over 90%, versus advertising revenues, which again are primary drivers for other competitors, larger competitors, for instance, like Facebook, for instance. They generate the majority of their revenues from advertising because there are already so many people on their platforms for various reasons other than dating. So I think that's one of the primary challenges these two companies have faced in the past year. I think the macro discretionary component of user retention has been a challenging environment. And I think this is also one of the reasons why Citi is actually moving their price targets down respectively for both these names. They did decrease the price target for Match.com to 33 from 34. They maintain a neutral rating on this name, but at the same time, they did move their target down to $12 from $14 on Bumble, which if you look at that business in the past year, Bumble, they actually had, based on their Q1 report, 18% increase in user growth, as well as sales growth, which is still in the low double-digit range. But nonetheless, if you go back over the last 5 years, sales were in the 20+% range from a growth standpoint. And that was also quite a bit higher for Match.com. When you look at their sales in the last year, 6% higher versus 16% over the last 5 years. So I think what's happening here is there's obviously macro issues which are creating some challenges from a discretionary user, and maybe the marginal user has decided to cut ties with these companies to save some money. But at the same time, the average revenue per user has been decelerating for both these businesses, so they're not getting as much spending on a per customer basis that they have in the past.
So, George, I'm curious about the dichotomy and performance between these two, because I have to imagine that Match is faring a little bit better than Bumble, just given its vast portfolio of brands. I mean, it's not really doing that much better, but performance-wise, it is outperforming. So is that correct, that Bumble is I know they have not just Bumble, but they're a smaller company, frankly?
Yeah, that's the thing. You're right. So if you look at the performance of the two, you'll notice that Match has basically performed better. It's still down 31% versus 52% for Bumble. And the reason being is what you say, Jenny. It comes down to the second, third, and fourth tier brands that this company has. I'm not going to name a bunch of them, but there are plenty. So this company has been growing through acquisition over time, whereas Bumble seems to have more of an organic growth strategy, and it doesn't have the scalability across multiple platforms, appeasing multiple users who have different sort of, preferences and tastes in dating versus others. So I think Bumble, if you look at it, it's still a relatively new company, and it has been issuing secondary offerings to finance its expansion. It did revise its app completely going back to April, but it doesn't seem like that it's actually increasing the amount of users as expected. If you look at Wells Fargo, they actually denoted in their recent downgrade in the stock, in terms of the price, not the rating, but they denoted, the channel checks going into the third and fourth quarter of this year. In terms of new user growth, it's expected to be around 100,000 versus 125,000. So they didn't expect as many new users based on the revision of their app going back to late April.
To make a kind of tough comparison, but I mean, I think fair one, can have a great idea, can have someone with tons of users, and it can still have economic issues that kind of lead to underperformance from an investment standpoint. Think Snap. No one's saying no one uses Snap. No one's saying that people aren't on that platform, but it's consistently underperformed because they've failed to monetize it the same way that other platforms in their space have. George, we'll leave it there, though. We're out of time. Appreciate it. George Tillis, Senior Markets Correspondent for the Schwab Network.